This presentation is for information purposes only and doesn't constitute investment advice nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading foreign exchange, futures, cryptos, and equity markets can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of the future. Reward, risk, and stops. Now you are in level 3 and this is section 11 and lecture 1. There will be 4 or 5 more lectures of this section because this is the most important aspect of trading. In this lecture we consider fear and greed and some other basic risk related parameters which are very much important. Regardless of the experience, it's equally good for experienced and inexperienced novice traders. Whoever follows these rules mentioned in this section 11 will remain ahead of others. Quick review. In the past few classes you have learned about a number of technical analysis techniques that we will utilize to construct trade strategies. All of these various techniques do not matter without the proper money management, trade management, and understanding the concept of risk and reward. This lecture is the most important lecture which separates professional traders from retail traders. The best system will fail over time if proper money and trade management is not utilized. Proper money and trade management can turn a mediocre system or method into a decent system that can be tradable over the long term. Is trading about money? No, trading is not about money. The goal is money, but it's not about money. You are being taught a clear and effective trading method here in this lecture. However, without developing an instinct or gut, you are likely to spray based on the wrong inputs. It's called style drift, and it dooms novice traders as well as some intermediate and advanced traders as well. Trading is about ROI, return on investment. Attaching money to something generally changes a person's behavior. When you are trading the money, you are not trading the market. For example, playing poker for chips versus money, a star athlete who just signed a big contract, trading in sim account or simulated account or demo account versus a live account. So basically, if you are successful to manage your fears and greed, only then you can become a successful trader. Regardless of the trading techniques and whatever you have learned so far, if there is no proper money management which helps you to manage your fear and greed, you can't be a successful trader because you won't ever have confidence on your own techniques. Attachment to the money triggers the lizard brain, which is full of fear. When the lizard brain is triggered, your behavior changes. Fear and greed are generally amplified. A person's perception of reality can change because brain directs focus to what the lizard brain thinks is important, given its own desires and not necessarily the desire of the non-lizard brain. The lizard brain tends to be stubborn and unwilling to accept a loss. It would rather gamble on a smaller or possibly no loss than to accept it's wrong and face a guaranteed loss. In real example, you might come across many traders who have this mentality just because of fear, and they say, I don't want to lose anything. And that's the fear. Although they have the disclaimer, this is the most risky field on earth. Why? Because it's leveraged margin trading. Your $1 is generally acting as $100 and so on. So if you don't want to accept, the risk, why you are into this field? Sorry. So that's the wrong mentality which you have to amend it. The lizard brain hates a loss more than it likes an equal gain. The lizard brain searches for patterns in random events and makes long-term decisions based on illogical short-term events. Detaching from the money gives you the best chance of clearly analyzing the market and setting up the trades. Detachment doesn't mean apathy. Doing the correct action does not always lead to immediate gain, but correct repeated action can lead to long-term gains. So the main thing is the consistency and your system. If you would never develop a system, you will never have confidence because you would never have tried it repeated times. So correct repeated actions. Return on investment is not measured in ticks or points. Ticks are not an actual currency. We hear all the time from traders, I made 10 ticks, or I made 100 ticks, or I lost 20 ticks, or I lost 50 ticks. What does that mean? Ticks are a unit of measurement. It's not a standard from which to measure your success at trading. It has nothing to do with your entire portfolio. Somebody is trading $1,000 account, somebody is trading $100,000 account, and so on. So what a ticks could mean? Just nothing. Return on investment is measured as a percentage of capital gains versus the amount of risk capital. Risk capital equals investment funds allocated to speculative activity. Risk capital refers to funds used for high risk, high reward investments such as junior mining or emerging biotechnology stocks. Such capital can either earn speculative returns over a period of time or may dwindle to a fraction of the initial amount invested if several ventures prove unsuccessful. Diversification is the key for successful investment of risk capital. In the context of venture capital, risk capital may also refer to funds invested in a promising startup. So how does it apply to us as traders? Because we all believe in these facts which we just discussed. You might have learned a lot of times. Diversify your investments. Don't put all your eggs in one basket. So now how practically we have to use this thing? Let's discuss. Risk capital equals trading capital equals your investment in your trading career. Thinking in terms of ROI helps you do what's right. It's the simplest way to fast track your instinct. The money is your live trading account, is your investment. You should be willing to lose most or all of your risk capital. Believe it or not, but this is an admitted fact. This will help you do the exact opposite. The successful trader has a handle on what percentage of trading capital they are willing to risk per trade, per day, per week, and per month. A fixed tick stop is considered risk management by lazy traders who really lack in discipline. The price action will dictate not only your initial target but also the appropriate stop. It's very important to memorize and implement in your trading. The price action will dictate not only your initial target but also the appropriate stop. We'll explain it further, but just to overview. If you just make it 10 ticks, 20 ticks, okay, my trade target is 20 ticks profit and 10 ticks loss. Regardless of the price action, then what's the benefit of learning all the trading techniques and technical analysis and all the calculation? Is just useless. You just flip your coin and see, I want to buy today or sell today, and that's it. My profit target is 20 pips, my stop loss is 10 pips. The game is over. No, it's not like that. Fixed stop amounts do not adjust to volatility. That's another factor. Sometimes markets are volatile, sometimes they are not. So we have to take different scenarios in both the conditions. And price action stops take into account volatility and areas where if the stop is hit, the trade setup has been violated. So all those who are following fixed ticks or fixed pips or fixed dollar term stops, they are violating price action movements. We have already examined one key way of determining key price action, which was in the class on significant level, if you remember. If a trader keeps the same position size for every trade, then they are not risking the same percentage on every trade. Hence, position sizing is the second most important aspect which we will be discussing in this lecture. For example, let's say you are trading the S&P E-minis contract and you always trade, say, 10 contracts. On the first trade, your stop is 8 ticks away, thereby creating a risk of 80 ticks or $1,000. On the next trade, the stop is 16 ticks away, thereby creating a risk of 160 ticks. It is $2,000. So it means in one trade you are exposed to $1,000 risk, and in other trade you are exposing yourself to double risk. So it's not a system. Under this scenario, your risk changes on every trade, since you are always trading the same position size. Professional trader varies the number of contracts per trade, thereby keeping the dollar risk per trade constant. That's very, very important. In this example, the trader has a $50,000 account and is willing to risk 2% per trade. The trader, therefore, is risking $1,000 per trade. In the first example, where the stop was 8 ticks away, the trader would be risking 8 into 12 and $5 per contract. Trade it, so $100 per contract. The trader could then trade 10 contracts because $1,000 per trade per 100 per contract equals 10 contracts. So we always adjust the contracts. However, in the second example where the stop was required to be 16 ticks away, the trader would trade less contracts based on the same $1,000 risk per trade. In this example, the trader is risking $200 per contract because of 16 pips. So they can only trade 5 contracts instead of 10 because we have to make $1,000 trade risk in that particular trade. So we lower the contracts by dividing the total available risk with the per contract dollar amount. Gives us 5 contracts. Let's see here. You can find many position sizing tools online, but I would really suggest you to make your own Excel sheet or program, which we will discuss in next advanced lectures, how to develop it, the trading journal and stuff. Anyway, here you can see, generally we suggest the risk per trade should be between 1 to 3% based upon many other factors now, which needs personal consultation, lifestyle, saving, and many other factors we have to consider. But generally, let's take example of 2% here, as we have been discussing in the past few examples. So here you can find a lot of stuff automatically give you, okay, if the price action dictates you to do with the 10 pips, 20 pips stop, or whatever it is. In any case, you can tailor the number of contracts by increasing or decreasing the contracts. You can make it, because here you can see if your account is $50,000 and you keep it 2% risk per trade, means in every single trade you are not supposed to lose more than 2%, right? So 2% of 50,000 comes $1,000. So based upon the points as you have received from the price action, which charts are showing you that there should be a stop, and the safe stop of course is the one which never gets failed. So but based upon a lot of studies and whatever efforts we are doing to learning all these things, after that, with a bunch of studies, we evaluate, okay, these are the points. So based upon those points, then we evaluate how many number of contracts we must be doing. If that's the type. Sometimes you go with this even 20 contracts, but again, if there is a narrow range and stop losses of least points, you can of course increase the contracts accordingly, mathematically, without involving your sentiments or fear or greed into it. Because most of the novice trader, if you ask them the question, hey, I see your statement, you are trading sometime 2 lots, sometime 20 lots, sometime you are making $500 profit, in some trade you are making 1,000 profits, okay, that's fine, but in some trade you are losing 500 and in some trade you are losing 1,000. So losing more than a fixed percentage of loss per trade is something which mess up literally the whole trading scenario. You will never end up with any trade plan, you will never gain any confidence, and we're not trying to be 100% accurate. You must have heard the name of Larry William, a very famous technical analyst, and in fact we have Larry William percentage R nowadays he's teaching. He has been winner of trading competition probably in 1992, and to your surprise he turned $10,000 into, at one time it hit almost $1 million, but ended up in almost 600,000 plus. And the probability was almost 66%. So out of 100 transactions, he made profit in 66 only, and even then he made such a good profit based upon the consistent results and the system. So if you follow the system, you will develop the confidence which will help you overcome the fear and the greed, and that's the key to success. Apart from any experience or new trader, this is something which you can learn in one day and start implementing and make a healthy trading practice. So in this chart you can see if stop loss points are 5, then you will go with 4 contracts. If stop loss points are decreasing, so on the other side contracts are increasing and making it $1,000 per trade. You don't know which trade will be a winner or loser, so you'll have to stick to the plan. And I had a workshop once in London, and the title was Plan Your Trade and Trade Your Plan. We'll discuss it in some other video. But if you don't have any plan, then too you are standing nowhere. And if you don't follow your plan, then too it's useless if you just study and don't implement. So position sizing is critical because you don't know which trades will be the winners and which ones will turn out to be the loser. Determining the correct position size ensures that all your losing trades will approximately be the same dollar amount. This is extremely important once we get to the concept of reward, risk, winning percentage, and trade expectancy, which we will discuss in next lecture. Sometimes for a trader to have the flexibility to vary their position size to a greater extent, they have to switch to a smaller contract, or the mini lots nowadays are micro lots which are available. For example, they may need to switch from crude oil CL to QM or YM like this. Nowadays in Forex and many other CFD platforms, there are mini lots and even micro lots available, so you can easily adjust it. By changing to a smaller contract, the trader has much more flexibility to control their position size. That's another view of position sizing tools as we discussed, but again I prefer to do it manual on every trade. Risk per trade as percentage of account. Another benefit of basing your risk per trade on a percentage of your account is that it manages your dollar risk per trade in proportion to the growth or shrinking of the account. Let's say a trader has a $50,000 account and they are willing to risk 1% per trade. That would equate to $500 of risk per trade. If their account shrinks to $40,000 due to some losses, and then 1% risk per trade is kept constant, then they will only be risking $400 per trade instead of originally $500. So as there are losses, equity is coming down. If you are based on percentage, the risk of losing per trade will also, come down, and will give you more opportunities and more number of trades. As their account suffers a drawdown, the account will decrease at a slower dollar amount, versus if they just, kept trading a fixed dollar stop loss throughout the whole process, then the scenario will be different. We'll just see it in the table form. Similarly, if their account grows to $60,000 and they keep the percentage per trade at 1%, then they will be risking $600 per trade. So as the account grows, the dollar amount risked per trade grows and their account grows faster on a dollar by dollar basis. Just look at this chart. Here you can see on this side, this is fixed dollar risk per trade of 500. Like in every trade, the maximum risk this trader is willing to take per trade is fixed $500. And if the equities going down, we take the example of losing streaks. Losing streaks mean the consecutive number of trades in loss. We just presume for the calculation purpose from 1 to 50 that if he made 50 consecutive losing trades, the balance of that $50,000 for that trader who is fixed dollar is 500. So after one loss, equity will be 49,500, then 49,000, and so on. So after 50 trades, his equity will be $25,000 left. On the other hand, if the trader with the same equity of 50,000 is having 1% risk per trade, so for the very first trade it comes same $500, and he also had a loss. In first loss, his equity was same 49,500. But after that, the next trade, he doesn't have $500 to lose. He has $495 to lose. Apparently, it's such a small amount that everybody negates. But after 50 trades, once you see the results, he will have $30,250 left. It means he's $5,250 ahead of other person, in spite both lost in 50 consecutive trades. On the other hand, let's take example of 50 winning streaks with the same $500 risk per trade and 1% based. And here we will presume risk-reward ratio is the same, which we'll discuss in the next lecture. Means if he's having $500 risk, on the other hand, he's also expecting $500 profit. So after one trade, equity will become for both 50,500. The next, it will become 51,000. But here, now it's a bit increased because he's taking 1% profit as well, which is 505, and so on. After 50 trades, you will see in consecutive profits by 500, per trade, this account will grow to $75,000, while the one who is having 1% percentage strategy, the equity will be 82,232. So that's 7,232 ahead, without any change in the trading strategy or anything else, just by simply adopting this essential risk per trade based ROI. Similarly, if you just take the case where on the 50,000 account, likewise in this example where risk per trade is capped 2% or $1,000 fixed, so after 50 trades you will see the account will be totally liquidated, washed, because the client could have lost $50,000, and on the other side still $18,250 $208 would be left. And in case of winning streaks of 50, you will see after 50 trades the profit will become $100,000, and for that who is taking 2%, it will grow to $134,579,000, and you can see this real difference. Assignment: take the current contract and method you trade and perform the following exercise in your simulated account. Convert your fixed tick risk method to an ROI based percentage. Watch some open sim trades and force yourself to look at the percentage of loss or gain as opposed to ticks or dollars. Generate a table as we just showed you like this. Comparing your current risk method with an ROI percentage based method, and instead of 20, 10, 20 or 50 trades losing streaks, I would prefer at least 50. Compare the outcome. You will see the results yourself, and seeing is believing. Once you'll go through it, it will give you more confidence. And you will be realizing it if you have not been doing it before, that how drastically it can really change your trading performance. Perform the same exercise with 10, 20 and 50 trades, winning streaks, and compare. Using a risk per trade of 1% and a fictional $100,000 account, take some of your past trades and calculate what your position size would have been on each. Do at least 20 trades. Summary: risk is not managed in number of ticks. Trading is not about money, it's about markets. Detachment from the money is the start of your gut. Apathy about the money is the end of your trading. The key to risk management in any market is position size based on a percentage of capital. Thanks for your time. Look forward in the next lecture of this very important section.